Before we begin today's discussion, we must state that this AI-generated podcast is for general information only and does not constitute financial or legal advice.
Right, and we strongly instruct listeners to independently verify all information and, of course, consult a qualified professional.
Yes, exactly. So, welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris.
And please note that this episode is current as of 3 July 2026.
Okay, with that compliance framework established, let's get into the substance of today's briefing. We are looking at the operational realities of cross-border private banking between Luxembourg and the Netherlands.
Right, it's a highly complex area. We're examining the precise legal frameworks that govern how these services are managed and communicated across borders.
And it's an area where, frankly, a lot of financial professionals make some pretty broad assumptions. You hear the term European passport constantly, right? And the general thought process is that once a financial institution is authorized in Luxembourg, they essentially have a free pass to operate in the Netherlands.
Yeah, that is a very common but fundamentally flawed assumption. The passport is really just the starting point. It's not a blanket authorization by any means.
Which brings us directly to the central thesis of the briefing we're analyzing today. The source is very explicit about this. Relying on the fact that transactions are merely recorded or booked in Luxembourg is fundamentally insufficient to evidence compliance.
That is the core must-know takeaway here. I mean, the booking location is, functionally speaking, largely irrelevant if the underlying client interaction wasn't handled properly.
Right.
To actually prove compliance when you're dealing with a resident of the Netherlands, the ultimate requirement is a very specific operational parameter. The institution must maintain a documented Netherlands control trail.
A Netherlands control trail. Okay, let's unpack this concept because it sounds a bit abstract. What does a control trail actually require in practice?
Well, practically, it translates into hard-coded rules within the institution's customer relationship management software, their CRM system.
Okay.
The briefing notes that this trail has to systematically document several crucial data points for every single cross-border client. So, first, it must track the specific passported services being offered, the exact legal status of the client, and, crucially, the entry channel.
Wait, let me pause you there on the entry channel. Why is the entry channel so legally significant?
Because it dictates the regulatory standard. Did the client proactively seek out the institution entirely on their own initiative?
Which is reverse solicitation.
Exactly, reverse solicitation. Or, alternatively, did the institution actively market to the client in the Netherlands? The regulatory requirements shift depending on who initiated the contact. So the control trail has to prove which scenario actually occurred.
That makes a lot of sense. So the system proves who knocked on whose door. What other parameters go into this CRM control trail?
It also needs to control the language used in communications, the specific marketing material provided to the client, and the exact documentation signed.
Wow. So it's highly granular.
Highly. Furthermore, the trail must document any physical or virtual visits, any formal complaints filed, and any exceptions made to the standard policies.
So, operationally, if a banker in Luxembourg wants to execute a trade for a client residing in Amsterdam, their system shouldn't even allow the transaction to proceed unless all these specific trail requirements are met.
That is the standard. It's not about pointing to a server in Luxembourg. It's about actively proving the how and where of every interaction.
Right, which again reinforces that central thesis. Relying on the fact that transactions are merely recorded or booked in Luxembourg is fundamentally insufficient to evidence compliance. Okay, so if this control trail tracks the activity, let's look at the actual activities permitted. This is our first major takeaway from the source. If an institution is authorized in Luxembourg, can they just offer their standard menu of services to a Dutch resident?
No, they cannot. That's a critical point.
Yeah.
Institutions have to actively map out their exact service perimeter on a strict service-by-service basis.
A service-by-service basis. So what specific services are we talking about here?
The briefing lists them explicitly. Deposits, lending, investment advice, discretionary portfolio management, the reception and transmission of orders, and ancillary services.
Okay, so they have to break the business down into those individual components. How is that perimeter legally established in the first place?
Well, for a Luxembourg credit institution, the baseline is the law of 5 April 1993 on the financial sector, We'll refer to that as the financial sector law.
Right.
Specifically, Article 2 of the financial sector law establishes the core authorization requirement just to operate domestically.
So Article 2 of the financial sector law is the domestic foundation. How does the law handle the cross-border aspect into the Netherlands?
For outbound banking services, the relevant text is Article 34 Bainon of the financial sector law. And this local provision implements a broader European framework, specifically what we call notification logic.
Notification logic. Okay.
Yes, this logic comes directly from Directive 2013-36-EU of 26 June 2013, which is commonly known as the CRD. Under Article 39 of the CRD, an institution cannot just start operating across a border. They must formally notify the authorities of their intent to provide a specific service in that host state.
So under Article 39 of the CRD, it's essentially a requirement to raise your hand and declare your specific intentions before acting.
Exactly, and that covers your traditional banking services. But when we move into investment services, like executing trades or offering advice, there is a parallel regulatory structure.
And that would be MiFID II, correct?
Yes, Directive 2014-65-EU of 15 May 2014, or MiFID II. The cross-border rules for investment services are detailed in Article 34(1)-3 of MiFID II.
Okay, and how does Luxembourg integrate those European rules locally?
Luxembourg transposed those rules into Article 34(2)-4 of the financial sector law. These provisions require the institution to submit a formal program of operations.
A program of operations. That sounds like internal administrative paperwork, but legally it's much more rigid than that, isn't it?
It is the defining legal boundary of the institution's capacity. If a specific service, say discretionary portfolio management, is not explicitly mapped out and notified within that program of operations under Article 34(2)-4 of the financial sector law,
then they simply cannot offer it in the Netherlands.
Exactly. If they offer an unnotified service, they are operating entirely outside their permitted perimeter.
And once again, that brings us back to the reality that booking the trade in Luxembourg doesn't legitimize the transaction if the service itself wasn't properly notified.
Right. The control trail is designed specifically to prevent an institution from stepping outside that mapped perimeter.
All right, so we have the strict mapping of the services covered. Let's move to our second takeaway, which deals with who is actually on the receiving end of these services. Let's say we have a high net worth individual residing in Amsterdam with, say, 10 million euros to invest. The institution probably labels them a private banking client.
They almost certainly do, yes.
So does that private banking label grant them a distinct legal status that allows the institution to offer more complex products?
That is a very persistent misconception in the industry. The term private banking client is strictly a commercial or marketing designation. It has absolutely zero legal weight under the MiFID II framework.
Really? So legally speaking, a client with 10 million euros doesn't automatically get a specialized status?
No, wealth alone does not equate to legal sophistication. The briefing is very clear on the actual legal categories that must be applied. First, you have the professional client, which is strictly defined under Article 4(1) of MiFID II.
Okay, professional clients under Article 4(1) of MiFID II. What are the other categories?
Next is the retail client, defined in Article 4(1)(11) of MiFID X. And finally, there are eligible counterparties, which are governed by Article 30 of MiFID X and transposed locally into Article 37-7 of the financial sector law.
So professional, retail, and eligible counterparties, those are the only recognized statuses.
Correct.
So going back to our wealthy client in Amsterdam, how does the regulatory framework view them by default?
By default, the framework prioritizes consumer protection. Therefore, a high net worth individual is legally classified as a retail client under Article 4(1)(11) of MiFID Time, which carries the strictest protections, unless they are formally and properly reclassified as a professional client.
And I imagine that reclassification isn't just a matter of signing a waiver, is it?
No, it requires a rigorous documented assessment by the institution. The individual typically has to satisfy at least 2 of 3 very specific criteria, which they must have carried out transactions of a significant size at a significant frequency. Their financial portfolio must exceed 500,000 euros, and they must work or have worked in the financial sector for at least 1 year in a professional position that requires knowledge of the transactions involved.
So if a client has 10 million euros from, say, a real estate sale, but they only execute 2 or 3 trades a year and have no professional finance experience,
then they do not meet the criteria. Despite their high net worth, they remain legally classified as a retail client under Article 4(11) of MiFID II.
That is a crucial distinction. It means the institution cannot legally market highly complex, high-risk professional instruments to them.
Exactly. And tying this back to the Netherlands control trail we discussed earlier, the CRM system must definitively document this correct legal status.
Right, because if an institution executes a complex trade in Luxembourg, but their control trail reveals the Dutch resident was actually a retail client who was never properly assessed,
then the institution has failed to comply with the operational parameters of MiFID II. They treated a protected consumer like a professional.
And as we've noted, relying on the fact that transactions are merely recorded or booked in Luxembourg is fundamentally insufficient to evidence compliance in that scenario.
It offers no defense whatsoever.
Okay, so we've mapped the services and we've classified the client. Let's move to the third core takeaway, the actual day-to-day communications. If a banker sitting in Luxembourg drafts an email or sends a brochure to that retail client in the Netherlands, whose rules govern that specific communication, since they are operating under the European passport from Luxembourg, do they just apply Luxembourg's local advertising standards?
It seems like a logical assumption, but it is incorrect. The briefing emphasizes that when dealing with Dutch clients, you must apply the relevant Dutch rules in practice for all communications and marketing.
So the European passport does not override local communication laws in the host state.
It does not. You still have to adhere to the host country's operational requirements. The briefing points to specific Dutch legal standards here. First, there is Section 4.192 of the Wet op het Financieel Toezicht.
That's the primary Dutch Financial Supervision Act, the WFD, right?
Yes, the WFT. Alongside Section 4.12 of the WFT, institutions must also comply with Section 2 of the AFM Policy Rule on Provision of Information of 30 September 2024.
And the AFM is the Dutch regulatory authority for the financial markets.
Correct.
So what do these specific Dutch provisions actually require from an operational standpoint? If I'm reviewing a marketing document, what is the standard?
These Dutch rules explicitly require that all provided information must be correct, clear, and non-misleading.
Okay, correct, clear, non-misleading. I have to ask, isn't that a universal standard? Doesn't the Luxembourg regulator require the exact same thing?
They do, yes. In fact, that overarching standard is established at the European level for investment services. You'll find it in Article 24 of MiFID II, and it's reflected locally in Luxembourg under Article 37-32 of the Financial Sector Law.
So if Article 24 of MiFID II establishes this across Europe, and Article 37-32 of the Financial Sector Law enforces it in Luxembourg, why is it so critical that the institution specifically applies the Dutch WFT rules?
Because the interpretation of what constitutes clear and non-misleading happens at the local level.
Ah, I see.
Right. So the Luxembourg regulator might review a document and find it compliant under their interpretation of Article 37-32 of the Financial Sector Law. However, the Dutch AFM, applying Section 4.12 of the WFT, might evaluate that exact same document and determine that its presentation is misleading to a Dutch retail client.
So it's not just about the broad European directive, it's about how the local host regulator enforces the spirit of that rule in practice.
Exactly. You are subject to the Dutch regulator's specific interpretive standards when you target residents in their jurisdiction.
Okay, this has been incredibly detailed. Let's pull all these threads together to understand the final practical implications. We've gone through the strict mapping of the service perimeter under the Financial Sector Law and MiFID II. We've clarified the rigorous assessment required for client status, and we've established the necessity of applying local Dutch rules like the WFT for communications.
Right.
So, connecting this back to the control trail, what happens if a financial institution doesn't hard-code these parameters into their CRM? Say they have the passport, they book everything in Luxembourg, but they simply start calling Dutch clients without building this formal control architecture first.
The source material is unequivocal on this point. Institutions must formalize these Netherlands-specific cross-border controls before any recurring client coverage begins.
Emphasizing the word before.
Before, yes. You cannot retroactively build your compliance evidence. Without formalizing these controls up front, the institution's cross-border servicing immediately falls into an operational gray zone.
An operational gray zone? And in a strictly regulated environment, that is an untenable position. If an authority reviews a client file and the institution cannot produce a systemic trail proving the entry channel, verifying the legal status under MiFID II, and demonstrating adherence to the AFM standards,
then they cannot evidence compliance, which perfectly validates the central thesis we've discussed. Relying on the fact that transactions are merely recorded or booked in Luxembourg is fundamentally insufficient to evidence compliance. The local control trail is mandatory.
It's a fascinating look into the highly structured mechanics of cross-border finance. The operational reality is far more localized than the concept of a European passport suggests.
It requires a highly disciplined operational framework, yes.
Well, before we close today's deep dive, I need to relay the mandatory closing details directly from the source material we analyzed.
Right.
We want to thank the listeners for tuning in. We invite you to support the work by subscribing on Spotify, Apple Podcasts, or wherever you get your podcasts, and on the Bertrand Mariaux YouTube channel. And you are directed to follow and connect with Bertrand Mariaux on LinkedIn to share comments and likes.
Furthermore, please visit the website bertrandmariaux.com to read the full written analysis of today's topic. We also want to remind listeners that you can listen to the French edition of this briefing titled Le Luxembourg Fundcast.
The underlying text provides a very meticulous breakdown of these regulatory parameters.
It certainly does, and it leaves us with an interesting structural question to consider. We often view the European framework as a mechanism for seamless cross-border market access. But when you examine the intensely localized compliance realities, the rigid client classifications and local marketing interpretations, it raises a question regarding market access. Does this intricate web of controls genuinely serve to protect the everyday consumer, or does it inadvertently create a regulatory barrier that primarily limits competition to only the largest, most heavily resourced institutions?
That tension between consumer protection and market accessibility is a continuous regulatory debate. It is indeed, and one worth monitoring. Thank you again for joining us for this analysis. This was the Luxembourg Fundcast.